We do.
Okay, so sorry. Let me see now. Oh my God. Let me see if you are able to see my screen. It has been tough for me this time today. Just last week was better than this. Yeah. Yes, last week was better than this lecture. Yeah, chapter 3. Okay, did you see my screen?
Yeah.
I'm still asking. I want to be 100% sure that you've seen it.
Yes, you see.
Oh, very good. I'm very happy now. Oh, I don't know what happened to my computer today. Last week was very smooth. So what slide are we on? Slide, I think 9 or 10. Slide 10. Okay. All right, slide 10 here. I think we have looked at the previous slide, Mexican Grill income statement. We recall we discussed how Mexican income statement is segregated into operating section control the focus of the business, and then we move further to other items sections. So then let's look at the next item there, that is operating revenue. We know the operating revenue.
I can see your PowerPoint screen.
There is no sharing.
What?
There is no sharing. We can't
There is
see
no sharing.
You are not seeing my screen?
Yeah, we cannot see your PowerPoint screen.
I saw your screen, but it's not the PowerPoint.
Yeah, we can only see your Microsoft
It's the chat.
Teams screen.
Yeah, yes.
Okay.
No lecture slides.
Are you seeing, what have you seen now?
We are
It's
not
a
seeing
chat.
like
We
the
see
screen
your
is still
face
showing
only.
the Microsoft Teams.
Huh?
The screen is still showing the
Teams
Microsoft background.
Did you see this slide? This screen? I've just opened.
No, we see your screen, but not the PowerPoint.
What did you see?
We're seeing the Teams.
Oh, Teams.
We
Yes.
see the Teams, sir, right?
I thought you see the Teams. Right.
Professor, you need to select the application or the file that you want to share. I think you selected the Teams application to share. You have to select the PDF presentation.
That was what I selected. I don't know what happened. Okay, let me come back to it. Let me come back to it. I will come back to it. Did you see my screen now?
Yes, now we see it.
Okay. All right. Okay. We were, let me see if this will work. I'm back. Okay. All right. Do we see this now? Did we see this now? Let me see.
Yes,
Okay.
yes, we see it.
Yes.
Okay. Okay, let me see. Okay. All right. I said we were on, we did last week, I think we stopped at Mexican real income statement. And we were able to know the dissection of income statement into operating section of income statement that has to do with the core operation of the company, and then other item sections. Who can tell us the composition of other item section? Anybody can tell us the composition of other item section? What is comprising of?
An example can be an interest for a loan.
Yeah, good.
The interest can be given to us, or maybe we loaned to another company.
Okay.
It goes
All right.
both ways.
Okay, and then loan to other individuals or company, or even the employee, if you give money to employee and you make interest out of it. So we have interest expense. We call it interest expense because a company that borrow money from a bank or a financial institution need to pay interest. So we have called that interest expense. And then we have what we call the interest income, the one you just explained, that has to do when the company gives out loan to individual or other company. That is not, because it is not the core of their business. That is why it is segregated from what we call the operating section of the business. What is the operating section? Who can tell us what the operating section comprises of? Who can tell us what the operating section comprises of? Anybody else?
I can
Yes.
speak again. Is it okay? Okay. So
Can I?
it comprises. Yeah.
No,
Yeah.
you.
Sure. Go ahead. Go
Okay,
ahead.
go ahead. Go ahead.
Okay. There is supplies expenses, there is wages, there is rent, there is the repair items as well as the repair expenses as well, as per the statement.
Mhm.
Okay. There is also there is operations expenses and administrative expenses.
Okay, so what in the nutshell, what do we call operating section of the company in terms of income?
This is related to the goods or services they are providing. So what
Okay,
is related to that?
Okay, so the operating, you can see the income section is segregated into two. One, we have the operating section. That is the core of the company's business.
Hello, do you hear my voice?
Testing.
Oh, so for the
I
size
think
of
Professor
professor.
has disconnected.
Yeah,
Yeah.
yeah. This.
So it's not our problem.
Yeah,
It's not
I
our
thought
internet.
I
It's
thought it
his
was my
internet.
problem.
Yeah, I still thinking.
Okay, let's wait for him then.
Okay, let's wait.
Hello.
Hi, Judeline.
Oh, is
Yeah,
it okay
so
like
I
this?
think the professor is having connection problems.
Oh, okay. Thank
Yeah,
you. I
they're
think
calling.
it's on my. I think it's on my side.
Yeah, I thought so too for a while.
Thank you.
Anytime.
Everybody there? Everybody there?
Yes.
You can't believe it. They took power here, so they just restored the power back to us. So I lost power, so they just restore it.
Yes, yes, we noticed.
So I lost power, so they just restore it. So the thing affected the internet, everything was affected.
All right, sir.
Huh?
Maybe UPS will serve better.
Oh yeah, no, I didn't put my backup on, so they have not done that. Maybe this was a minor problem, so.
Okay, sir.
It was a minor problem, so they restore it back in less than 5 minutes. So, but I will take care of that next time. At times, these are things that we cannot control, you know. Did you see the PowerPoint?
Yes, yes, we see it.
Okay. All right. Okay. So we're discussing the balance sheet because from there will be the income statement. From there we'll be running through the slides so that we get things done. And we said that the operating section is the core of the business. And in most cases, it is mandatory that they segregate operating section from any other thing that brought income. You will come to realize that not only interest expense and interest income, we have also when the company sells their asset that is owed, there may be gain or losses. So you will see that there will be gain or losses on sale of fixed assets. For example, they have a car or a vehicle that is very old. They want to sell it and buy a new one. So when they sell that vehicle, at times it may lead to a gain or a loss of income. So that will come on, all those things will come all under other items section. So let's move to the operating revenue. We talked about it already. The amount, that is the amount earned and recorded from companies' day-to-day business activities. So we have talked about that. Is there anybody who have question on that? No? Okay. Operating expenses also is the contract to operating income, because operating expenses, they are spending that money on day-to-day basis to make sure they're able to pay for their expenses. And it's different from cash expenditure. So operating expense, when you talk about operating expenses, we are strictly talking of expenses. We are not talking of payment of debt or payment of loan or repayment of loan or purchase of assets. Purchase of asset has nothing to do with operating expenses. Purchase of asset is what we call capital expenditure, which is quite different from expenses, day-to-day expenses. Any question on that? No question. Okay, let's move on. So this is our example of what we call operating expenses: depreciation, supplies expense, wages, rent, general administrative loss and gain on disposal of assets. If you remember, I mentioned loss and gain on disposal of assets. That is loss and gain on disposal of assets falls below under other income or other items. Then you have insurance expense, utilities, and repairs and repair. Yes.
Okay, your slides is showing operating revenue.
Huh?
I said your slides is showing operating revenues, and I'm not seeing the.
Not operating expenses.
No, sir.
This is operating revenue. That's what you are seeing.
Yes, that is what I'm seeing.
What of this? What of operating expenses?
It's not showing for now. I don't know if any of my colleagues can confirm that. There's
Please come. Is there anybody else?
I think Wellington, your slides, you're changing them yourself. So click on your screen and say to presenter.
Oh, did I?
Click on presenter. And I
There
think
is no issues with you, Professor. There is no issues with you. We are seeing operating revenues right now.
Okay, you are seeing
Okay.
operating revenue. Oh, okay.
no. Yes, I think it has just changed now to operating expenses.
To operating.
Yes, operating expenses has just shown up now.
Did you see this?
Yes,
yes,
I can see it now.
yours is good, Professor. I think the problem was with Wellington.
Okay. Are you seeing operating revenue now, everybody?
Yes, Professor. I'm seeing operating revenues now.
Yes,
Everybody? Okay. So, okay, we don't need to go back to operating revenue since we have talked about it. What?
Professor, we are not seeing any slides anymore.
Me too. I'm not seeing any slide myself. Okay. I will go back again. This is funny. Okay. Okay. Please tell me what you have seen now. Tell me what you have seen now. Is there anybody who can tell me what is there on the screen?
Yeah, we're seeing
Yes,
the
we
chapter
see
3
it.
slide.
we are waiting, sir.
What are you seeing on the screen now? Do you see?
And now we can see,
Chapter
sir.
3.
Oh, very good.
Chapter
Chapter 3.
sir.
Okay, let me go back to. Have you seen operating revenue now?
Yes, sir.
Yes, Professor, we can see operating revenues.
Okay. All right. Today is very, very light. Power gone. Okay, so that is operating revenue. And then have you seen operating expenses?
Yes.
Okay. So we talk about how to distinguish between operating expenses and what we call capital expenditure. They are two different things. Is anybody confused with the difference? Anybody confused with the difference between operating expenses and capital expenditure? Nobody. So everybody know that. Very good. All right. And then we look at the example of operating expenses. And then, okay. So is there anything different on this screen from depreciation up to repairs that you say, okay, can you explain this? All right, so let's quickly move. Then other income statement. I talk about other income statement. I say anything that is not within the core of the company's business, it will go under other income. So as soon as we draw a line, the operating income, that is, we look at the income that is coming in, total income, then we look at the expenses, operating expenses, we subtract it from total income, we have net income. So that net income is before tax and before other income. So now we will now include other income, interest revenue, interest expense. As soon as we include interest expense, interest revenue, and then gain or loss on sale of assets, then we will now arrive at the base income before tax. Then we calculate the tax, take the tax out of it, and then we arrive at the net income after tax before we move down to appropriation. Okay,
Excuse me, Professor, I have a question.
Yes.
the income statement and the cash flow statement might have the same points, the same numbers?
Not necessarily true. It may not be so, because for income statement, remember, there may be sales on credit. Supposing somebody buys something on credit, $100.
Okay, it will not be in cash flow because it's not related to cash.
Yes, it will be in income statement, but it will not be in cash flow. Very good. You see that?
But the expenses will be in the same, in both of them, right? The expenses will be in both of them.
Expenses will be there if it is not credit. Remember, to company also buy something on credit, right?
Yes, I'm not talking here about the credit. I'm talking
Yes.
here about the cash. Like if a shop, okay,
As far as yes, I got you. As far as cash is expense to buy that items, it must appear on income on cash flow statement. And it also, if revenue has been earned and it can be matched to the income, yes, it will also appear on income statement. But in most cases, as soon as cash is gone, cash has been taken. As soon as cash has been taken, removed from the system, from the company's system, it must reflect on the cash statement. Okay. So, using data analytics in the restaurant industry to increase revenue decrease. You can see for each company, they have different mode of capturing income. There can be multiple sources, like in restaurant, given as an example, they may create a kiosk, create apps online, put tables, create tables and so forth. All that match into creating an income for the company. So how do we recognize operating activities? How do you recognize and measure? So cash basis accounting is used by many sole proprietors. A lot of proprietors, so they use their own strictly cash. And also small partnership, they use that to determine their own performance. So they spend their cash directly. It is simple and permitted for tax purposes. Cash basis accounting record each cash payment as cash inflow or outflow, and each receipt as inflow. That is inflow, outflow. The product's net cash flow information that is often quite adequate for organizations that do not need to report to external users. You see, for sole and private companies, they don't need to report to anybody. It's just them, and for tax purposes. So they don't need to go into some details, which you will see for public accounting, for public companies. Public companies, that is companies registered in the stock market, they have a lot of obligation to report. They report to the stockholders, to creditors, to the management of Security and Exchange Commission, stock market, everything. So they need to report, even to the public. People need to know what they are doing. Okay. So let's look at, explain the accrual basis of accounting and apply the revenue and expense recognition principle. So let's look at that quickly. By the way, everybody got it. Say everybody got textbook now, right? Correct? Everybody got textbook, so we don't need to be jumping and thinking that, oh, okay, these are just PowerPoint slides. I'm very happy that everybody got textbook. Okay, how our operating activity, okay, that one we got that. Okay, this is what we call revenue recognition principle. There are 5 steps. One will be identify the contract between the company and the customer. Number two, identify the seller's performance, obligation, promised goods and service. Determine the transaction price, then allocate transaction price to the performance obligations, recognize revenue. So you only recognize revenue if it is a product. Who can tell us when do we recognize revenue?
When materials are delivered.
Somebody can mute, the rest can mute. Go ahead.
Okay, Professor, your solution to your question is that when the other four conditions has been fully complied to.
Okay, but now for just living, yeah, we look at those steps. Some of them are implied steps. Some of them, they don't need to be written in black and white. But if I tell you now, if you are the financial or accounting manager of the company,
yeah,
when do you recognize that revenue has been earned on this particular product?
Okay,
when we refresh.
Well,
I think we should raise hand. I think someone to raise hand for
okay. When somebody raise hand, the rest should always mute so that it will be very clear for us. Okay, I'm the only one who don't need to mute, or I will continue to talk. So okay, go ahead. Go ahead, Rodas. Okay.
Okay, so I think when the product or service is delivered to the consumers or customers.
It's delivered to the customer. That is, I would call it 90% done. If the product is delivered to you, you want to buy what new pencil to use for your class, and then I come to you, I manufacture pencil, I come to you, I give you pencil, I deliver the pencil, and then you open it, the pencil is half. It's not full pencil. What will you recognize that as a product that has been delivered?
No.
No. So it's when delivered and accepted.
Yes.
You must include that. You don't, when you deliver to me and I don't accept it, it does not imply that you have completed the sale. The sale is not complete. It's only at the point of delivery and acceptance. So that is what you should, the overall principle, you have seen there are 5 of them, but the overall thing there is, we don't want, if it is a manufacturing company, we know that they will manufacture the goods, they produce the goods, they attach prices to the goods, all those things are implied. But the most important thing is at the point of delivery and acceptance. Okay. So revenue versus cash receipt. You know, cash can be received anytime. Supposing I want to buy what iPhone do we have now? iPhone 13, right? Supposing now they are Apple, they are producing iPhone 14. They say they are producing iPhone 14, and then I call Apple. I say, okay, send me I want to pay for 4 iPhone 14. They will tell me now, we've not produced it yet. We are still planning it. I say, okay, but I want to pay. So when you pay, will you recognize such revenue? Who can answer that question? If I buy iPhone 14, not yet produced, 4 of them, $500 each, that is $2,000. Will you recognize it in income statement? Who can answer that question? You can raise your hand.
No, that's liability.
Huh?
No.
This is liability on the company.
Sir, you cannot recognize it on the income statement because the goods has not been yet delivered. The obligations has not been fulfilled.
Very, very good. You see? So if you understand that analogy, then you'll get everything about revenue versus cash and credit sales or prepayment. A customer has prepaid, so you don't recognize it. So that becomes a liability to the company until goods are delivered. So expense recognition principle, the expense recognition principle, also called the matching principle, require the cost incurred to generate revenue be recognized in the same period, a matching of costs with benefits. Salary, wages to employee who work during the period, that should be recognized. During that period. Supposing within that period, that same period, revenue of 5,000 is generated and there is a salary of 2,000. So it will be recognized within that period. Also, utilities for the electric. Supplies used. Then facilities rented. Supposing the company is renting the factory, so they have to recognize for that period as well. Then equipment. So recording cash expense versus cash payment. Cash may be paid at any of these times before the expenses is incurred. If cash is expense before the expenses is incurred, what do we call that? Will it be an income? Will it be an asset? Will it be liability? If income is, if that is cash is paid before the expense is incurred.
It's an asset.
It's becoming an asset.
Payment,
Yeah.
yes, payment in advance.
Good. Payment in advance. That is what we call prepayment. So it will be an asset. It will be there in the balance sheet until the actual delivery of the service or product. Okay. Let's keep going.
For instance, rent.
I
said, for
yes,
instance, rent paid in advance.
Very, very good. Rent paid in advance. You know, in most cases, the landlord will tell the company, you have to pay me 12 months rent. If you are not in this class or you don't have an idea about accounting, you say, oh, but that will go to income statement directly because we have spent 10,000 for rent. So that should be buried in the income statement. That is not correct. So I'm very happy you are in this course, so you know that will not be recognized by income. So assuming, let me ask a question. Assuming 10,000 is for, okay, let me say 12,000 is to be paid for 12 months rent in advance. Company has paid it. And as at March, will it recognize anyone as an expense?
Yes.
3,000. How much? How much would be? Huh?
$3,000 will be
$3,000. That's very good. So that means you guys know a lot about this, you know? That's very good. Okay. Question of ethics. Ethics is very, very important. You see that those who deviate from standard accounting practice or GAAP, some of them are in jail. Some of them are in jail. They take that very seriously because if you distort accounting statement, you misinform a lot of people, both external and internal. For example, if your company is not making profit and then you keep reporting that, oh, we are making a lot of profit, you mislead a lot of people like the staff, the employee will be thinking that, oh yeah, our company is doing so great. And the external creditor will be relying on that and give you money if you need money. So you don't mislead them. So managers are motivated to produce earning results that meet or exceed investors' expectation to bolster stock prices. Greed may lead some managers to make unethical accounting and reporting decisions, often involve falsely revenue and expenses. So why should manager that is being paid salary become greedy? Who can give us a good reason for that? Manager that is you are getting paid. If you are being paid 10,000 a month, you are getting 10,000 every month. Why should they become greedy? Who can discuss these ethics with us? Yes.
Maybe their income, maybe their expenditures is more than income, so they are looking for additional place where to rob, where to increase their income.
But the owners of the business, the shareholder, didn't send you to go and try to cut corners to make income. There may be some reason that will motivate them to be greedy.
I think to show that they are good managers, they are like managing well the assets of the company. At their time, the company made a great profit, so the value of the manager himself will increase. He will get known that he is the wow man, that he made the impossible happen.
Oh, okay. That is a very good answer.
But sorry, Prof. Sir.
Yeah.
Your question, is it personal or as regards to the organization? Because when you talk about managers being greedy, we want to know, is it as regards to the manager, his personal income? I mean, what prompts the manager to be greedy, as in causing him to commit fraud? Or is it as an organization?
It's not a question of fraud. You are the manager of ABC Limited, okay? I'm paying you your salary 10,000 every month. You are satisfied. You like the salary 10,000, but then you may be greedy because of some of the perks and benefits that come with the job. That was why I was asking. I said, why should they be greedy when they have salary? At times they are well paid. And somebody gave me a good answer too. He said because they need promotion. Yeah, they want to be promoted. But the real thing there is that there are a lot of companies that practice what we call stock option and reward. Reward for making so much money. You are being paid 10,000, but if you make more money, the stock price will go up, and they may give you what we call stock option. So that is why some managers now become selfish and start pursuing selfish interests. They want to hit that target, they want to hit that goal, so that they will be able to get stock options, stock rewards, and so forth. So there were so many companies. I've seen here that they have included WorldCom. If you look down, WorldCom. WorldCom was one of those technology companies. In 2002, WorldCom recorded 11 billion in expenses as assets. You hear what? They recorded 11 billion in expenses. But what do? They transfer it as an asset. That is a very, very misleading and fraudulent transaction. You can tell us what is wrong with that transaction. 11 billion in expenses being recorded as an asset. How did they do that? Technically, how did they do that? What type of entry did they pass to do that? What type of adjustment, if anybody knows?
Debit expenses.
Huh?
Debit. Like it's an expense paid in advance. So it can be an asset. Until the
expense paid in advance. Yeah, expense paid in advance is recognized. It's recognized in accounting, yes. You can pay, like you said, you pay the rent in advance. Yes. That is an authentic transaction.
Or it can be an expense paid to buy an asset. No, sorry, that was wrong. That's wrong.
But that was what the Wellcome did. Is fraudulent. That is what we are saying. It's not in line with accounting principle. It's not a genuine transaction. What you are explaining is genuine transaction, but in this case, it's not. Okay, let me delve a little bit into it. What they did was that when they run their expenses, that is income, less cost of goods sold, or less administrative expenses, arrive at net income. The net income is a loss. Net income becomes a loss, a minus. So what did they do? They credited net income. For example, 11 billion credit to net income. So if you credit net income 11 billion, then the contract credit is a debit to assets.
Yes.
Asset is the balance sheet item. So they are now hiding their losses in the balance sheet while they are posting a positive net income.
Yes.
Did I make myself clear?
Yes.
So
yeah.
So you can see that is fraudulent. They incur the expenses. Instead of reporting the expenses in the income statement, they credited income statement by that expenses so that they will now post healthy income statement. So that is fraudulent. So that is not what you guys know before. What you explain is prepaid expenses. Yeah, it's recognized. But when the expenses has been incurred, this 11 billion has been incurred. So it's supposed to go into income statement. These are expenses that have been incurred in income statement. But how do they hide it? They now credit that at the income statement and posted a huge debit balance on their assets.
Okay.
But fortunately, the auditors did not query when they saw huge balances on the assets. They did not query it. They're supposed to have queried it. So that is why we have a lot of regulations now in place to check that. In fact, the CEO of this company and similar and the chief financial officer, I think they are still in jail till today.
25 years. Wow.
Yeah.
I think, sir, the best way they can do that is by increasing the sales revenue.
Oh, very good. Well, yes. If you know that it's just like you. If your salary is 5,000 a month, if you now decide to spend 8,000, so that means you have a minus of 3,000, right? Yes. So you either go and take extra job, or you tell the company to increase your salary, or you go and get a new job that will pay you maybe 8 or 9 or 10,000. But these people, the Wellcome did not do that because there was no way to do it. The only way they did was to hide that expenses under assets. They call it other assets. Hide it there and then post. Then in that case, their income statement is big. A big income statement. Everybody clap for them. Oh, wow, this company is doing so well. So that was it. So, well, it was uncovered. I think the external auditors that audited their book is Price Waterhouse. Yeah, the external auditors that did the books, and then they themselves too had a problem. Okay, let's look at learning objective 3, apply transaction analysis to examine and record the effect of operating activities of financial statement. We may not do much on this. Most of this, as far as you know, what is income, what items are recognized as income, and what items are recognized as operating income, operating expenses. These transactions is now being done by the computer. So as far as you know, the principle that revenue, in this case, look at revenue, anything revenue is a credit to this statement. Expenses is always on the debit side, is a minus. So revenue minus expenses will give us what we call the net income. But like Qualcomm, you see what they did? So in place of this revenue, they credited that revenue by that 11 billion. And instead of, if the debit was on expenses, so that have knocked off the debit that was there, and then it went into income statement. That is very, very, it went into the balance sheet statement. That is very, very unethical. And we don't expect young managers to do that. Okay, this is a summary of revenue and expenses impact balance sheet and income statement. So revenue always is an increase. Expenses is a decrease. So in this case, the entry, the computer always pass. In those days, you know, all these entries, we pass them manually. But these days with the computer will just credit this. Revenue, if revenue of $50 is to be recognized, they will credit this revenue account $50. Expenses, $10 is to be recognized. They will pass a debit, $10. Okay. So account in this case, account must always have credit balances. Revenue must always have credit. This must always have debit. And you can see the way the company recognizes that, yes, we are performing well. The revenue must always be, the total revenue must always be greater than the total expenses, operating expenses. That is when the company knows, yeah, we'll make profit. If the expenses is less than, if revenue is less than expenses, then the company is really going into trouble. Any question about revenue and expenses? No? Okay, these are all transaction analysis. Transaction analysis, how to recognize revenue, say was a revenue earned by delivering goods or service. So all those questions we have to ask before you recognize revenue or expenses. So you can go through the analysis of Chipotle transactions. You will see how they were able to recognize the revenue and expenses. If it is incurred for that period, yes, it will be recognized. If it is not, it will not be. Do we want to take 10 minutes break and come back? Let's stretch our leg for 10 minutes. And then we continue from there. 10 minutes. By quarter to the time we should be back. I don't want to say quarter to my own time. Quarter to the time we should be back. I'm back. Okay, we've looked at income statement and the analysis of each transaction. We will not really go through them. We will not really go through them, but then it's the T account is always a very good system of recording debit and credit. So most of these items are being done by the computer system. But yeah, it's good to know, to have an idea on how it is, how that is the theory behind the numbers. So, but we will not really go through all those things that is being done now. So, for example, let's look at one example here. This company sold food and beverages to customers for $1,359. $44 was sold to university on account to be paid by the university in the next quarter. You can see that the $44 is sales on credit. That would be sales on credit. So 139 is reduced by that amount. So you can see that the total sales was 1,359. How did they treat it? How did they treat it? Cash out of that 1,359, 1,315 was cash. So that goes to cash account directly. And then the other one will go to what we call the account receivables. $44 will go to the account receivable. So the total sales revenue will be 1,359. So all the transactions happen this way. You see the debit, you see the credit, and then whatever is cash goes to cash account, and whatever is credit will go to the account receivable, but the total will now be matched up. So the total debit here, if you look at it, is 1,359, and the total credit is 1,359. So they cancel out. And that is how transactions are being recorded. That is the way computer does it. So in that case, this 1,319 will be debit to cash. Credit of that goes to revenue. Account receivable credit debit will be 44. Contra credit will go to restaurant revenue. So these are all the transactions, the way it is being recorded. And I would not want us to go through it. If you want to go through it, yes, you can take your time, go through those transactions the way they are recorded. There are so many examples that have been given. There are so many examples there. You can work on those examples, go through them yourself and see if there is any question in the future you have. Let me go to prepare the, let's go to learning objective 5. For those examples, you can always go through those transactions yourself and look at it. So prepare a classify income statement. So income statement here, we know what is involved. So this is income statement prepared and analyzed for this company. And then it gets to the total income, the total expenses, and that is what is transferred to the income statement. That is what is transferred eventually to income statement. And I told you, just like we have consolidated balance sheet, I told you here too we have consolidated statement of income. Who can tell us what a consolidated income statement is? Who can tell us based on what we know about consolidated balance sheet? Who can tell us what a consolidated income statement is?
Parents company and their subsidiaries.
Very good. So in this case, as soon as you see consolidated, what should come quickly ring in your ears is that, oh, okay, this is a big company. This is more or less like a parent company. So that means he has other children. Or in our own financial statement, yeah, they are subsidiaries. Subsidiaries are the children. So they may have 1, 2, 3, 4, 5, 6, 7 millions of subsidiaries. So those subsidiaries now at the end of any financial year, what do? They prepare their own income statement and send it to the parent company. It's the parent company that will consolidate. For example, this is a restaurant. Probably they have restaurant in where you are, or let me say in United States, we have 52 states. They have restaurant in 52 states. I'm just giving an example. So in that case, so when they are now consolidating, they are now taking revenue, restaurant sales revenue of all those branches put together, add it to that of the parent branch, and that form the restaurant sales revenue for this company. Somebody is coming in, they say he cannot come in, admitted the person in. Okay, so then how do we interpret, compute and interpret net profit margin ratio? Recall that we had one ratio when we did balance sheets. Who can remember that? Who can tell us what ratio was that and what it measures? We had one ratio in balance sheet. Who can tell us what that ratio is and what it stands to measure?
I think it's a profit margin ratio.
In balance sheet, we did balance sheet last time, and we towards the end we did one. There was one ratio we discussed for the balance sheet applicable to balance sheet.
Was it a profit margin ratio?
Profit margin ratio is for income statement, and that is what we are going to. We are going to look at the profit margin ratio right now.
Asset equal liability plus unrisk weight.
That one is equation of the financial statements. Asset equal liability plus stockholders equity. That is financial equation of financial statement. What I'm asking is that in the balance sheet, you remember, now we are dealing with income. In the balance sheet, you recall, we talk about a ratio. And what was that ratio? That ratio measured liquidity. Am I correct? It measures current liquidity of the company. What ratio was that?
Current ratio and the asset ratio.
Very good. Current ratio, which is the measurement of, if you remember, we used so many examples. I said, this company ratio is this. Can this company pay off their short-term liabilities and still be comfortable? We talk about that. So as we go along, we'll be meeting some of these ratios. They are key to financial decisions making. They are key. They give us an insight into what is going on. For example, if you want to know the liquidity ratio of that very company, you will just add up the current assets divided by current liabilities, and then we know. From there, we know, is this company liquid or not? And industries have different measure of liquidity. 1-for-1 means exactly the value of current asset equals the value of current liability. That means if the this company is told to pay off all current liabilities, they will pay and become zero. That is one-on-one. But if it is 1.5, that means that company will pay that liability and still have 0.5 left to meet future obligations. So in this case, we are looking at what we call net profit margin ratio. There are other ratios, but this is one of the key performance ratio as far as income statement is concerned. We have what we call gross margin ratio also, but net profit margin ratio is also very, very key. It has to do with when we look at the net profit, we divide it by total sales, what we get will be the net profit margin. I want everybody to take note. As we go along, we will meet some of these ratios, and you need to remember them. If I give you a test today, one of those questions will be on ratios, because as a financial expert or MBA graduate, you need to know how to interpret those ratios. I give you the numbers. I tell you, go to the balance, go to the income statement or go to the balance sheet and compute this ratio and tell me, interpret the ratio and tell me what they mean. Some of these things, we cannot really get them in the textbook, but these are the things, my own focus on. That is the focus in most cases of most programs on finance or accounting. Okay, so the next one is the next objective is compute and interpret the net profit margin. Net profit margin. So the net profit margin, how effective is management in generating profit on every dollar of sales? How effective? Like I told you, it is total net income. That is, how do we derive the net income after taking administrative expenses from sales? What we arrive at is income before tax, income before other entries. Other entries like the interest expense, interest income, sales gain or loss on sales of assets and so forth. After doing all that adjustment, we arrive at what we call net income. And net profit margin will be net income all over net sales. That is operating revenues. So in this case, we've seen that of this company, Chipotle, using reported amounts from Exhibit 3.1. You will see that the net income is 350. Maybe we look at, can you turn to Exhibit 3.1, everybody? Previous slides, you have the slides. 3.1, Exhibit 3.1. Who has Exhibit? Who can? Exhibit 3.1, okay. Exhibit 3.1. So to see that, I think that should be slide 9. Slide 9. Slide 9. Okay. Have you seen net income on this slide? If you see net,
yes, 350.
So 350, you pick net income. Okay, then you look at the sales.
That's 5,586.
Okay, so let's go back to the. That is how to pick it. You pick it from their income statement. So if I send you to go to income statement of Apple, pick their, calculate their
So it will be 0.062.
0.062. Okay. So that would be 0.0627. But the most, or you put it in percentage terms. In percentage terms. You will see that 0.0627, anybody who don't study MBA or who is not very knowledgeable, they will say, what does it mean? 0.0627. But almost everybody knows something about percentage. So it's always good to present it in percentage terms, 6.27%. You see? So that means net profit margin ratio for this company is 6.27%. How do we know whether that is good enough? How do we know if it is good enough? Or performance-wise, how do we know that? The net profit margin is 6.27 for this company, 6.27%. How do we know that it's good or not good enough?
So it means that we are getting like profit from the sales. So if this goes up, then our sales also like our profit goes up.
Well,
I
if
don't
you
know how to put it down.
Okay, yeah, you have a little bit of idea. If you look at in terms of years, if you look at it, we have 2017 net profit margin 0.394. Have you ever seen it? And then in 2018 we have 0.363. And then 2019 0.0627. So you can see that of 2019 almost double that of 2017 and 18. Because 2017 and 18, they were on 0.0363. But if you look at these numbers, the first thing that you will ask yourself is, in 2017, it was 3.94%. 2018, they went down. What happened? As an analyst, that's the question you want answer. In 2017, they performed better than the following year, 2018. What happened? So you need to know that. So that is when you dig into the theory behind the numbers. You want to know what happened to the numbers to reduce from 3.94 to 3.6. But then
either there is no sales, their sales became less, or their expenses became higher.
No, we don't. But, well, if they operate at the same level of operation, we expect either the income to go up, the margin, that is the net profit margin, to be higher. But in this case, it was lower. That means something happened, either extraordinary item or something extraordinary event has taken place. That is why their profit nosedive from 3.9% to 3.6%. But then, good news is that in 2019, they move up not only from 3.6% to 6.2% or 6.3% approximately. We also, you can see that as an analyst, you don't only want to be concerned with when the profit goes down, the margin goes down. You want to know why, yes, so that we will be able to let the public know what is going on in this company. But also when it goes up, we want to know what did they do that is so perfect that make them be so expert in increasing that profit to that level. What have they done that is so good? Why we need to know all this? If there is any reason why their performance went down for the profit margin, based on profit margin. If there's any reason why that happened, maybe because of something they introduced or a new product that is not good in the market, so many reasons, then there is need for them to be able to stop such practice or stop. If possible, if the product is not good enough, why put it in the market? So we need to know, they need to know that so that they will be able to guard against reoccurrence in the future. But for 2019, it went up. We want to know. Probably they introduce a new product and that product is selling. That product is selling very, very, very well. If the product is selling very well, yeah, they should produce more if possible. Can they produce more? That would be the question. Though that will involve them testing the market again and see if more people will buy that product. So this is how we use the numbers. And then let's look at now their competitors. There's another analysis entirely. If you look at their competitors, 2019, their close competitor, El Polo, Local Holding, and Shake Shack Incorporation. See their profit margin in 2019. This is 5.6%. So they beat their competitors. Here it is 4.1%. So they beat their competitors. So you can now see, oh yeah, in terms of when they are, so that means they are good player in the market or in the industry because they are able to beat their competitors. So those are the analysis to look at. Then the overall analysis, which I don't have their own industry. The industry data also have to be compared. Every industry, they have standard data. So for 2019, the standard data for restaurant, you have to compare it and see if they perform better than the industry. But we know from this analysis, from this limited analysis, we know that they perform better than their closest competitors. So that is very, very good. And also we know that from 2018-19 figures, that means the trend is now positive. They are going up, they are moving higher in positive direction. Any question about that? Any question? No question. Okay, let's look at the last objective here. Identifying operating transactions, demonstrate how they affect cash flow. We have discussed this already, but then, yeah, it's good to look at it. It's good to look at it. Effect of operating activities on cash flows. You will see that for simplicity, we always identify those items that affect financing. We put it, we call it, we just use F. Financing, we use F. I is for investment. O is for operating. So if you look at from investors, when they receive money from investors, that means investor is giving them money. So that would be plus financing. So it will be addition to financing, so it will be a positive number. And then from the bank is giving them loans plus financing as well. Sale of investment, that would be investment. When they sell investment, that would be a plus investment. Then from customer, when they receive money, they sell their product from customer, that would be positive operating item. Sale of land is positive, is investment, and OOR. So we put them, we classify each items as either F for financing, I for investment, and then O for operating. So there is need for you to recognize those items. So for our test next week, I will ask you to identify what these items are. Is it investment? Is it operating? Is it financing? So you need to know those. Those are the things we need to know. For the debit and credit transaction, is the system. You need to know the transaction behind those numbers. I'm not expecting you to go to your company and tell them, okay, I learned this, I want to pass this entry myself. Computer is doing that. Computer updates everything, they update the ledger, the account for us, but we need to know what they are. If investor is giving the company money, will you call it operating? Will you call it investing? Will you call it financing? You need to know the classification of each of those transactions. And that is how it will appear on the T accounts. Those that has to do with plus will go to the credit side, minus debit will go to the debit side. And then at the end of the whole entries, the total of the credit must balance with the total of the debit. And that is how the transactions are being classified. Any question? Any question? Okay, if there's no questions, let's take a 15-minute break. And then when we come back, we will introduce a little bit of chapter 5. And then we will go from there. And then I will post quiz for chapter 1, 2, 3. I may not include 5, just the first 3 chapters, because I know we are not going to do much on chapter 5 today. Next week, we will continue with chapter 5 and 6. So let's take 15 minutes and then come back.
So, Professor, this means till the next week, we'll have to study chapter 1, 2, 3 and finish all assignments. 1, 2, 3, 4, we didn't continue. And the main obligation is the assignment number 3, right?
Yes. So chapter 1, 2, 3, you study it, finish the assignment on chapter 3, because I know you have done chapter 1 and 2 assignments. So finish assignment on chapter 3, and then study chapter 1, 2, 3 for the first quiz we are going to get next week.
Okay. Can the quiz be an open link till for 24 hours so we can be here and return from our work, please?
No, I don't understand your question. Ask a question again.
Yes, I'm asking that, of course, the quiz will be in Moodle as in the form of a link. So we need yes, we need the due date to be 24 hours from adding the quiz, so we can have the time to do it, because lecture time is during our work. A part of it is during our work, so we need to be ready when we return from work.
Okay, I will post it. Do you want to do the test on Monday or Tuesday or Wednesday? Before we go, just pick one of those days, give it to me, so that I give it to you and then provide you that link within 24 hours to do the test on Monday or Tuesday or Wednesday. Quiz number 1. And okay. Quiz number 1 will be 50 points. I will just stay with 50 points. And then in place of quiz number 2, all what you have posted on the discussion, introduction, and the first items you posted, I'll put it for quiz number 2. We'll not do quiz number 2 again, but we have our final exam. And then the assignments have been given will be among the assignments. So let's still take the 15 minutes and come back this by. So that means half an hour, that is about, my time will be 12:30. So look at your time, it will be that time, 30 minutes. Okay? so that we have 30 more minutes to run through it. I know we've spent a little bit of time, but we should be able to start chapter 5 and then we close from there. I will post the usual assignments later on after the class. Okay.